I just want to welcome everyone to Multnomah Group's review of the second quarter capital market environment. Um, Appreciate you joining us this morning. Just a couple of housekeeping items. We are planning to record this session, and so we have put everybody into a listen-only mode. If you have questions, feel free to use the Q&A panel, and we'll either address those or get back to you after today's session. Um, my name is David Williams, and I am a senior consultant at Multnomah Group. I work with a number of institutional retirement plans, and I also sit on I sit on our investment in our investment committee at Multnomah Group. We're going to walk through the capital market report review, which is included in our quarterly investment summary reports. With that, let me jump forward into the market commentary. I'll hit a couple of items here and then work in some additional comments through the various exhibits. I guess first and foremost, first quarter GDP here in the U.S. was bad. The expectation is that things will, the drop in the GDP will continue into the second half of the year. The U.S. economy shrank by 5%. That was, the final estimate or the final report for the first quarter, obviously as a result of the COVID outbreak and the shuttering of the economy, both in the U.S. and globally, as the attempt to slow the spread of the disease was instituted by governments around the world. It's fortunate or unfortunate, maybe, today that we're doing this session this morning. We had the release of the first estimate of second quarter GDP. The first release of U.S. GDP for the second quarter came in at an annualized rate of a drop of 32.9% for the second quarter. I'll just say it again, a drop of 32.9% annualized for the second quarter. The quarterly rate there is 9.5%, but we tend to, the benchmark is, or how it's reported is on an annualized basis. So 32.9% drop in GDP for the second quarter. That's the worst quarterly drop since the quarterly rates have been delivered starting back in 1947. Just to give you a little perspective, prior to this, the worst quarterly drop was around 10%, the first quarter of 1958. And even in 2009, during the Great Recession, the largest drop was right around 9% on a quarterly basis. Obviously, the 11-year expansion that started coming out of the Great Recession ended in February, and we've now moved into full recession. One of the highlight numbers in the report that came out this morning, which is the first of three reportings that the Bureau of Economic Analysis will release over the next couple of months, is that personal consumption, which, if you've sat in on these sessions before or had a Multnomah Group consultant speak with you in the past, you'll note that personal consumption drives about 2/3 of U.S. GDP, and personal consumption was down 34.6% for the quarter. So, broad-based decline across all areas of the U.S. economy, but consumer behavior dropped off significantly during the second quarter. As we kind of look at, obviously the reasons why are well known, but we did see quite a bit of support from the federal government with the CARES Act back in March, amounting to about 10% of US GDP, or that $2 trillion figure. And then we also had significant support from the Fed, with interest rates being right around 0 to 0.25% for their benchmark lending rate. Um, Additional activity from the federal government during the second quarter is the extension of the Paycheck Protection Plan program, extended after the end of the quarter into early August. And then again, the continued support from the Fed, both from the interest rate side as well as an expansion of their balance sheet through asset purchases within the market. On the jobs side of the equation, each week there's a release of new jobless claims that came out this morning. So for the week ending July 25th, we saw another 1.4 million new claims for unemployment protection or unemployment protection. And that was a bit higher than expected. Just as we march back into the month of March, each week we've seen at least 1 million new claims since really the shutdown of the economy started back in March, and so that those unprecedented numbers continue through today. We did see some return to work, quite a bit return to work. About 7.5 million workers returned to employment during May and June. But as the pandemic continues to be a significant issue, there are still new jobless claims and significant jobless claims on a weekly basis being reported. Let me jump forward and we'll start to talk about some of the capital market implications during the quarter. So we'll start with U.S. equities. Really supported by that significant fiscal and monetary response. Investors were buoyed by that, and you saw strong returns in the equity markets here in the U.S. And outside of the U.S. During the second quarter. The S&P 500 rebounded. It was up 20.5% during the second quarter, which follows the 19.5% decline in the first quarter. So for a year to date, through June 30, the S&P 500 recovered most of its losses, but was still down 3.1%. For the quarter, you can see in this upper, maybe you can see I recognize it's a small chart, but in the upper left-hand corner, we show returns by sector for the S&P 500. You can see that all sectors of the S&P 500 were positive for the quarter, led by consumer discretionary, the dark or maybe traditional blue at 32.8%, and then technology and energy up around 30.5%. So strong performance from some of the growth areas of the market. Consumer discretionary, as consumers felt more comfortable of stay-at-home orders being lifted, some going back to work. There was quite a bit of increased spending relative to the March and April period, pushing those consumer discretionary stocks up, as well as just continued strong performance from the technology sector. The energy sector benefited from the rebound in oil prices coming off of their lows that we saw in the first quarter. On the laggard side, we see that utilities and consumer staples were positive, but not nearly as strong as the rest of the market. Before I jump off of this, I thought it's interesting just to kind of look across the different time periods. So looking at longer 1 year, 3 year, and 5 year time periods ending June 30th, you see that that technology sector, is clearly leading the S&P 500 on the positive side, and by a factor of 2 to 3 times the the other sectors. As we look at the bottom of this page, I think it's interesting to just make a note of those longer term trends of growth outperforming value continued here in the quarter, with large cap growth returning 27.25% versus large cap value being up 11.7%. And you can see that that continues really in all time periods, growth outperforming their value counterparts. For this quarter, we did see that small cap marginally outperformed large cap, but longer term, large cap continues to outperform small cap. From a valuation perspective, the S&P 500, one of the measures that we look at is the forward PE ratio. And just as a quick explanation, the forward PE ratio is looking at the price of stocks divided by the 12-month forward-looking estimate for earnings. And so on a valuation basis, the forward PE is being reported at 21.7 times currently, which is up quite a bit from the quarter one number, which was 15.4, and the long-term average for this measure is around 15. So what that says is stocks got more expensive on a valuation basis. And there's two things going on here. One, the price went up, so the numerator goes up, but also the earnings estimate has come down in large part because of the pandemic and the shuttering of the economies, and the expectation that companies will earn less over the next 12 months than was expected going into 2020. It depends on who you read or where you get the information, but anywhere from a 20% decline in earnings estimates all the way up into the 40% for this most recent quarter. Expectations is you'll see some recovery in earnings as the year goes on, and that most of the damage will be here in the second quarter. Ultimately, I think that's still to play out. One other comment on the S&P 500 I think has gotten a lot of attention here recently is the amount of concentration of some of the large technology companies. So Facebook, Apple, Amazon, Google, Microsoft amount to just under 20% of the index. And so there's a lot of the performance of the index will be driven in large part by some of by the performance of those kind of bellwether technology names, and those companies are fairly expensive on that price to earnings basis. Interestingly enough, I think you see a lot of those companies are reporting their earnings per share or quarterly earnings reports after today's market close. As we flip into the fixed income markets, looking at upper left-hand corner here, quarterly returns for fixed income, the Barclays Aggregate Bond Index, which is kind of the most commonly used benchmark in this category for fixed income, returned 2.9% for the quarter. That's adding on to the increase from first quarter, shows just a little over 6% return for the year-to-date basis. The Fed left interest rates unchanged. The yield curve so the Treasury yield curve largely unchanged, remains very, very flat. Long-term interest rates are very, very low. Short-term interest rates are obviously low, but long-term interest rates are low as well. So investors really are not getting paid to take long-term interest rate risk. And so we didn't see much movement on the interest rate curve this quarter. Given the fiscal and monetary support that the Fed has offered and Congress has provided, we did see the spread that corporate bonds trade at relative to treasuries compress during the quarter, which led to strong performance in investment grade credit, up nearly 9% for the quarter. High yield performed well, also up 9.3%. If you look at the year-to-date basis, we've seen full recovery in investment grade credit, but not full recovery in high yield. So obviously, with the slowing economy and higher probability of bankruptcies, you see those riskier assets are performing worse, as expectations are that some will not. Some of those credits will not survive, and so they haven't seen the full recovery on the fixed income side. You can see that on this next, on this next slide, we show performance by different levels of credit quality, and so from the highest to the lowest, as we move across, you can see a bigger recovery in those middle tranches, and then not full recovery, and some lagging performance on the most risky of high yield credits. If we flip to the outside of the U.S., on the international equity markets, I would say that we saw down here in the bottom left or bottom right-hand corner, EAFE, which is the proxy for developed markets, was up 15.1%. Emerging markets over here on the bottom left-hand side was up. Those were up more, up 18.2%, but both lagged their U.S. counterparts. One thing that was interesting as I was preparing for this, looking at valuation outside of the U.S., price to earnings ratio, so similar estimate, was at 16.7 for non-U.S. equities, so cheaper relative to the U.S., still expensive relative to their long-term averages of 13.5, but that's really been the case for the last 10 years or so, coming out of the Great Recession, that non-U.S. equities have been cheaper relative to U.S. equities, but still investors have generally preferred and driven the performance of the U.S. equity market up more than outside of the U.S. Ultimately, time will tell if those two measures start to move back together. The other interesting thing I noticed in reading some news articles in preparation for this is that the ACWI, so the All Country World ex-US benchmark, which really looks at, is a proxy for equities outside of the US, only has 11% in technology, while the S&P 500 has 27% of equities in the technology sector. So much more concentration in technology in that US benchmark, and with how technology has outperformed relative to broader sectors of the equity market. I think it helps to explain a bit of the performance difference that we've seen here, at least recently, as well as maybe longer term. flip to the chart that we call unpredictability of asset class returns, sometimes referred to as the periodic table of investments. But really what we're trying to show here with this document is the annual returns for asset classes that are offered in defined contribution retirement plans to participants. So if we look at the far right-hand side, 2019 and then year-to-date 2020, clearly a different picture between those two periods. Excuse me. I think what you see obviously is cash and bonds being the only two positive categories, which is a reversal from last year. But then also U.S. large cap stocks continue to lead, even on the downside, other areas of risk assets. At the bottom of the page, bottom of that column, we have real estate and commodities. We talked a little bit about the rebound in oil, which is helping increase the commodities. Still still the I guess poorest performing asset class shown on this, but also then real estate. Real estate continues to struggle due to some of the slowdown in whether it be business and or leisure travel for some of those hotel REITs, but also then with companies having many stay-at-home, working from home policies, certainly impacting the commercial real estate market as well. All of this is great information. I think we all get very focused on kind of day-to-day movements of the S&P 500 and what's the Fed going to do and how does that impact the fixed income markets. I think it's important to keep in context that many investors in defined contribution plans are looking for easy solutions that provide broad diversification, as well as ability to set it aside and move on with their daily lives through what in large part is seen as the target date funds or other default solutions that are multi-asset class, have professional rebalancing policies and oversight put into those. I'm going to focus on this the bottom chart here, this what we're calling the maximum drawdown. So we cut off the top, we cut off the positive side, and really just show you when a fund has a decline from a previous peak, how much is that decline and how long does it take to get back to the prior high. I think it's interesting to note, if we just focus over here on the far right hand side, that the many of the target date funds saw steep declines during February and March, and then have started to see recovery coming out of that. So many of the investors that were in those funds have seen pretty much full, in some cases, those near date funds, those funds for participants that are either in retirement or near retirement, saw almost full recovery and now have positive year-to-date returns through the end of the quarter. But even those that are longer dated, 2050 saw rebounded during into July, even some of those 2040s and 2030 funds have now back to having fully recovered and potentially posting some positive returns, depending on the day that you're looking at it. I think I'll wrap up with just a couple of comments coming out of since June 30th, as we're almost to the end of July. A lot has happened since the end of the quarter. The markets continue to rally. Not today with the news that has come out, but year to date through yesterday, the S&P 500 was showing a positive return of about 2%. The non-US equities were still down, but have recovered much of the loss. They're showing a loss of about 4.25%. So third quarter, we're seeing positive returns of about 5 to 6% for the equity markets, depending on the equity market benchmark you're looking at. And fixed income continues to post positive returns. The Fed continues to be accommodative, very dovish, and the Senate and the House are working on additional fiscal stimulus. The Senate introduced this week the HEALS Act, which stands for Health, Economic Assistance, Liability Protection in Schools. That is about a $1 trillion price tag currently, and they are working to negotiate with a proposal from the House that was 3 times that at $3 trillion that was brought forth in May. So the markets are expecting and hoping for some additional support from the U.S. government to continue to help consumers weather this the economic fallout from the pandemic. As we look to the rest of the year, the expectation is volatility will continue to be driven by events of the day or events of the week, whether that be with regard to economic or issues with regard to the virus. With that, that's the items that I was hoping to cover for you. If you have questions, feel free to, through the Q&A process, submit them. If we don't address them today, we'll definitely get back to you. And if you have questions afterwards, feel free to contact either myself or your Multnomah Group consultant. I'm going to pause for a minute and see if anything comes up. I haven't seen anything pop up into the Q&A panel, so I'm going to assume that means I've answered all your questions. And maybe with that, I would just say thank you for your time. We appreciate you joining our call, and if there's anything that we can do to be of assistance, please feel free to reach out. Thanks a lot and enjoy the rest of your day.